Okay, for this video, I would like to discuss about the trading psychology. This because very important because it will affect how the price movement in the market. So first of all, need to talk about the price movement before we go into the psychology part. This because when there's a price moving right like that, right? So there's a lot of reason play into part that affect the price movement. They can affect by the big boy, can affected by the human reaction and the psychology. Okay, so when there's a lot of buyer more than seller, the price will be pushing up. Okay, then you need to understand why the price will move up because buyer more than seller. This is like a demand and the supply. Okay, when let's you imagine that, let's say you want to sell a house. Okay, there's a house. Okay, when there's only one house, got three buyers, so the price tend to be increased, right? Because there's a more buyer than seller, because seller just one only but buyer got three. So the owner of the house will increase the price. The price will be high. But when the price is too high up, let's say this house initially is 100k. Okay, 100k here. Okay, when there is a three buyers, so this is the buyers, three buyers and one seller. So one seller. So more buyers more than seller, the price moving upwards. Okay, so if the price moving up too much, it reach 200k now. Reach 200k. So maybe then after that the buyer say no, I don't want to buy. Then all three say no, I don't want to buy. Then there's no buyer, so the price starting dropping down. Okay, because the feeling that this involve the psychology of the buyer feel that is expensive now. Expensive. Okay, when there's a discount price to 150k, so two more buyers coming in. Okay, I want to buy. Okay, two more buyers coming in, the price then will increase to 180k. Okay, so this price movement all affected by the action. Okay, by the action of the buyer and seller. Then the psychology behind that will affect their action. Okay, it will affect their action. So this is play a very important part in the price movement. So now we go into deeper. Okay, so in the forex trading psychology, we categorize into the four bias. Okay, the first one is overconfident bias. Second one is anchoring bias. The third one it will be confirmation bias. The last one, also the most important, is loss of aversion bias. Okay, let's we go to the first one, overconfident. Okay, so usually this is one of the mistake that people will be too confident over their system, trading system or their setup. They will stick to the setup because they are trade too frequently. Sometimes they are too confident. They will trading too frequently per day. They're placing extremely large trade, like very large lot size, maybe one lot, two lot, three lot. Then they're risking too much for one trade because let's say their account just having $1,000 only, but they are risking maybe per trade they're risking $100-200 per trade. So if they are losing continuously few trade, they will wipe up their account already. Okay, so how to overcome this? You need to ask yourself, have I ever jumped into the right into the trade that I had just been stopped out? Okay, not because I saw another opportunity, but because I could not believe I was wrong. So let's say you initially you plan, let's say the trade will be go up, your entering price will be go here, it will go up, but after your stop loss will be around here. Initially you mentally stop loss, you never set the stop loss, but after that the price moving downward, but because you never set the stop loss, you will keep hoping that price will be turning back up, right? Because you are so confident that this is the uptrend right now. So by the time you notice that the price never turned back, then it's too late already, because it's too far away down. Then you're losing money. It's growing like a snowball, getting bigger and bigger. Okay, so you need to ask yourself, have I ever put a trade, more than a trade that I normally would? Because usually, let's say your account afford to trade only 0.1 lot. So when you see this opportunity coming in, you are so confident that you are just put one lot. So meaning that you are risking your account, okay, more than you can afford. So this is very dangerous when you are too confident. So you need to set up a strict management rule that how many trade maybe you are going to risk 2% of account per day. So each trade you can take how many trade per day only. You just need to calculate how many trade per day, so that you will know that how much the losses you are afford in a row. If let's say you are allowed 4 trade per day, in a row you are losing all four, is your account still affordable to cope these losses or cannot? So you need to think it properly. Okay, very important. So how much if your account willing to lose? Okay, if you're losing 4 trade per day, let's say all in a row 4 trade per day, that maximum your losses hit, stop for today. So no trading for today. Okay, so you need to mentally prepare for any losses. Okay, come to the second one, anchoring buyers. Okay, so when you are anchored to yourself too closely to presence, you fear to see a dramatic changes that are possible as a currency pair fluctuate and the underlying fundamental shift. Let's say when you analyze this as an uptrend, you pull back, then you buy. So you are so anchoring to this trade is always an uptrend. It will never be downtrend, but eventually it will turn up, ranging then turn up downtrend. So you are still believe that it's uptrend. So you are anchoring to the trade that they were causing you more losses. Okay, so how to overcome this? So you need to ask yourself, have I ever lost money because I could not accept the trend has end? So to overcome this, you have to look for multiple time frame. So usually will be look at the 2 or 3 time frame. The first one will be look at the trend, but if there's a trend reversal, you will starting looking at the smaller time frame, starting have some changes over there. So you have an early signal from there, right? So the third one will be confirmation bias. So for example, if you believe that your Euro USD going to be go up, so you are looking for the news and you're so confident that and confirm already by multiple signal. Let's say your technical analysis say go up, you're looking at the news, Euro in a good news, say go up, then USD bad news, say go down. So everything fundamentally factor or support your belief that this must be go up. But if your price eventually turn around, then you have to accept the losses, cut your loss, accept the loss earlier. Okay, because if you keep believe that and you say that I'm already confirmed with many indicator and everything say go up, but even after that, if the price moving down, you need a second plan. Okay, so you need to keep an open mind that will help you catch a new move to avoid holding too long. Okay, to pass a belief. Okay, so because like that, people tend to some people will say that okay, right now I in a smaller time frame. If you're trading smaller time frame, so you are looking for the reversal here, but in the uptrend maybe still in the downtrend, so people might miss it out. So in this one, for your confirmation bias has to be careful as well. Okay, so the last but also the most important is a loss of aversion bias. So meaning that okay, let's say now let's say I want to bet with you $1,000. Okay, I will flip the coin. They head or tail, right? If you choose one, if you win, then you will win $1,000. If you lose, you're losing your $1,000 from your pocket. Okay, so are you still want to bet with me if I say like that? 99.9% will say no. They're not willing to risk their $1,000. Okay, they're not willing to risk it. Okay, although the chances to win is 50 over 50, right? 50% over 50%, but people are so feared to lose their $1,000 than gaining another $1,000. So this is a so-called loss of aversion. So this fear is more powerful motivator than greed. Okay, so we need to use the fear inside your trading strategy. So later we'll talk about more about the strategy, how we can analyze the price movement. We look at the feeling of the traders when they enter wrong trade. They got trapped in the certain price. So the trader who fear losses are much more likely to hold onto a losing position than trader who are accept certain losses and move on others more profitable trade. So meaning that when the people losing money, right, they tend to holding their position for longer timing than when in profit, they are willing to take the profit fast, but when they're losing, they will just open their trade for longer, hoping that the trade will be reversed. But eventually, if the price never reversed, they were having big loss already. Okay, so holding losing position is not only let you making losses but also let you missing out other good trade. Okay, so asking yourself, have I ever held onto a losing trade past the point where I knew I should have gotten out? So by right you should out already. In mentally you tell you your maybe one side of the brain tell you you have to be out by now, but another side say no, I hope that the price might be still turn around. Then end up you are wipe out your all money inside your account. So how to overcome this? Physically set a stop loss level. So when you want to do a plan, let's say this is your trading setup, you want to buy here, okay, then your stop loss, let's say you want to set over here. How if the price move down? So if stop out, meaning that okay, no trade, no, don't jump into trade chasing the price already. Okay, or here you don't jump in already, because once the price hitting your stop loss, it might turn it around, right? It might turn it around. How if you jump into the trade, you enter short now, so end up you are become more emotional trade. It's not a rational trade already. So you have to much more be careful. And some trader, they would like to, when the price starting moving down, they say okay, I'll move my stop loss down a little bit, so they tend to moving away their stop loss. So this one even result in the bigger losses. Okay, so the next video I talk about more detail about the how to analyze the price and the loss of aversion. All right, thank you. Have you ever heard that FOMO? FOMO. Okay, this is fear of missing out. Okay, so this is human nature. A lot of people, all the people, they were fear of missing out something good. Okay, so let's say when you see the price like this, will you buy this? But when you see the price like this, will you buy this? How about now? How about now? You buy this, right? So a lot more people will buy here. This reason because people fear of missing out. And this is the weakness of retail traders. That's the reason they put like a hook like that. Put a hook over here. Then the big boy come in and do a sell over here. Then market drop down. That's the reason a lot of people losing money. Okay, in this video we're going to discuss about FOMO. Okay, what is FOMO? So FOMO stands of F, fear, O of M, missing out, O for out. So fear of missing out. So that's mean people are have a kind of feeling that like scared of losing something good. Okay, they fear of regret of something. So this, I think, the all of the human being have this kind of feeling, the fear of missing out a good deal, good stuff, okay, and good thing, and something that able to reward you. They are feeling of losing something. So let's say in the forex market, let's say the price moving like this. So when the people looks like the price moving up higher and higher, right? So people tend to jump into here to buy it, okay, jump it. So when starting here, there's less people buying. So when the price is getting high up, so more and more people, a lot of people buying here, okay. When there's a lot of people buying here, they are chasing the market. So that what happened, usually the price will be going down. So all of the people here, they're being trapped, okay, will be trapped by the big boys. So you need to do a proper analysis about your momentum, about your health, the health of the trend, momentum of the trend. Then how is the big boys doing in the market? What's the big boy direction? Then what's the big boy currently doing? They are taking profit or they are running for their profit. Okay, so this is very important. So to avoid you are being trapped in chasing the market here. All right, thank you. Okay, before we start about the price sections, that's the most important is about need to dealing with our emotion and psychology. So that's why I'll first start with this one before we go into the deeper. Okay, so just now I believe that you have answered the quiz. Okay, a few questions. Okay, there's no right or wrong answer, but just to attest that everyone have the feeling of loss of aversion. Okay, meaning that if, okay, let's say the example here, imagine you are in a casino, you put $100 notes on the table to bet, okay, you lose. Will you continue playing or walk away? So majority people will continue playing. Okay, this is a feeling of loss of aversion. People feeling they are lost, they have greater feeling than they gain. Okay, that's why they want to try again. They will continue because they don't want to lose the money. Okay, then another example, now your friend say if you win he will pay you $200. Another way around, if you lose, will pay him 100. Okay, let's say they want to flip a coin. Okay, sorry, this one first. How if one day your friend say if I flip the coin, guess head or tail, okay, loser will pay $100, then you have 50-50 chance to win. Okay, so majority people will say no because they got the feeling of losing money. Okay, if someone come to you, right, say I bet with you head or tail, you will pay me $100. If you lose, then I will pay you if you win. But most of people, they will reject. Okay, they will reject. But now your friend say, okay, then like that, if you win, he will pay you double. Okay, $200. Another way around, if you lose, you have to pay him $100. So right now the gain will be more, right? But still a lot of people choose no. Okay, choose no, not to play because they are scared of losing money. So same thing in the forex tradings. So when people is losing money, right, when you, let's say you put you, okay, now you start this one 0.1 lot. Okay, 0.1 lot. Let's say you put the stop loss 30 pips. Okay, so you are losing, let's say already 3, hitting your stop loss already. Will you continue bet in this game at the same pair even though your setup is wrong already? A lot of people were still trying. Okay, they were still trying, go in over and over again because they want to revenge. They want to revenge the market. They will increase their lot size. After that, they will become 0.5 lot, become 1 lot. Okay, so getting more and more. then end up they'll burn up their account. Okay, so this is very important. If you set up already, hit your stop loss, that's it. Okay, that's it, you're out. Choose for the other pair to play it. Okay, don't stick on this pair again, because you have a strong feeling to revenge it. Okay, in this video we're going to talk about loss of aversion. Okay, as previously there's a 3 question of the quiz. I believe that you have answered all of the questions, so there's no right or wrong answer. So based off the question, so you will understand that how aggressive that your loss of aversion and how severe is your loss of aversion. Everyone surely have this kind of the feeling loss of aversion. Okay, now we're going to discuss what is the loss of aversion. So meaning that, let's say you answer a question, right? Let's say someone want to come to bet with you, like let's say $100. If I flip a coin, head or tail, you guess. If you win $100. If you lose $100. I can pretty sure that there's about more than 90% people choosing not to play, right? Because people are scared to lose the money rather than they win and gain the money. Even although that's like 50%, over 50%, you either can win or lose by just 50 to 50 only, but people are still scared of losing than gaining the money. Okay, so this is the graph you can see. Like if you bet with 50 cents, so the value, perceived value, is just about maybe here 18, but if you are losing the 50 cents, the pain, the perceived value is about 40, so you feel more pain. Okay, when you feel the feeling more greater than you gaining the money. Okay, so in cognitive psychology and decisions theory, loss aversion refer to people's tendency to prefer avoiding losses to acquiring equivalent gains. It's better to not to lose $5 than to find $5, right? So this everyone will be think like that. So this is quite common. Everyone will be have this kind of feeling. So we fear lose because our brain does not assign the same weight to 100 loss as it does to 100 gain. So the feeling is different. If you gain $100, you feel maybe the level of happiness maybe 1, but if you lose equivalent, which is $100, so you feel maybe 10 times much sad. Okay, the feeling is much greater than you gain the $100. Although it's the same $100, if you gain $100, you feel happy a little bit, but lose $100, you feel very, very sad. Okay, so this is the people why they keep like in trading market, they become gambling. So this is the very important. So you need to understand this so that you won't become gambler in the forex trading. Okay, so the happiness of finding $100 on the street doesn't equivalent to the frustration of opening of your wallet and realizing you lost $100. You need to pay for something. Okay, so meaning that let's say you open your wallet, you lost $100. The feeling is so much greater than you find $100 on the street. Okay, so or you think this way, not having a relationship with someone is not as painful as having someone and then losing them. Okay, let's say you are finding a girlfriend, right? Initially you are single, don't have any girlfriend, so the feeling is not painful that you are losing a girlfriend, right? Okay, so you can apply it. Okay, so our brain typically assign 2.5 times the weight to a loss, okay, as it does to a gain. We don't like to lose, as statistics show that the majority of humans will gamble in order to avoid a loss. So if you are in a losing position, okay, let's say when this is trending market, okay, let's say you are enter your trade, okay, over here. Okay, you enter your trade over here, you buy. Okay, you buy here. So when the price going up, you feeling good, right? Still feeling good, right? Still feeling good. When you see the price move down, what is your feeling right now? Is it you feel more pain here, the greater feeling here, or here? Okay, here you feel happy, right? Maybe a little bit, but here you feel very sad because now you see negative red color in the value, right? You are losing money. Okay, so if you are keep holding, hoping the market will turn, if you go, then end up you hit your margin or you hit a stop loss, you are losing money. Okay, so most of people when see, because market will be bouncing right up and down. So when you see market turn back up, they are like they are don't like the feeling of losing money. They will become gambler. They initially they put one lot, now it become two lot because they want to win back the one lot that they are losing. Okay, then the price maybe go as expected, go up, then up, down again. Okay, down again. So they are now losing money again. So now they going to, you see the price going up. This time they're going to sell it three lot. Going to sell it three lot. End up the price moving up. So they keep gambling 4 lot, 5 lot. End up their account blasted. So this is very dangerous. So because of the feeling and emotion of the loss of aversion, we will never follow our trading plan as earlier. Okay, so this is the reason why a lot of people, you plan, you set a stop loss. If you are lose, accept the loss. Okay, accept the loss because it's against your trading plan, because you need to believe and you need to put this concept in your mind. You won't be 100% correct in the market. Okay, sometimes you will be wrong. Okay, sometimes you will make mistake, but you need to accept your mistake. You need to accept it. Okay, if you are wrong, that's it, wrong. Okay, we won't have 100% correct. Okay, so this is very important. Don't become a gambler in the forex market. Okay, trade safe. Okay, so as you learn what is trend before, right? What is trend? What is H&M? Okay, so now we're going to combine those things all together in this advanced course. For those who haven't taken any basic course like a naked trading mastery course, so you can go back to attend that course before come to this one, because I just worried that we become confused if you just straight away come to the advanced courses. So okay, so if the uptrend, there's uptrend, meaning that there's a higher high, higher low, and higher high. Okay, this is basic. Then if lower trend, okay, downtrend is lower low, lower high, and lower low, right? Okay, so in the Elliott wave theory, they will say that there's a two wave, which is impulsive wave, right? Impulsive wave, which is if the trend is going up, that will be one go up, retrace, another up, retrace, then another up. So this one is they talk about in Elliott wave theory. Okay, so when the going down, there will be 1, 2, and 3 like that. Okay, then continue uptrend again. This is a pullback. Okay, let me just put, okay, then go back to red color. Then we go another impulsive 1, 2, 3, and 4, 5. Okay, this is what taught in the Elliott wave theory, meaning that we need to have 5 plus ABC. Okay, ABC. What's the meaning of this? Okay, so let's say this is uptrend. Okay, so meaning this is 1. Okay, go up 2. Then this is 3. Come down is 4. Then go up again is 5. Then A, B, C is this one. A, B, and C. Alright. So let's change to this color. So this one, long one, we call it impulsive wave. Impulsive wave, very strong wave. Okay, strong wave. Then the smaller one, this is corrective wave. Okay, just a resting of the wave. So when the price moving up, they need a rest, then moving up. When you go to the smaller time frame, you can see the 1, 2, 3, 4, 5 wave and A, B, C here. Okay, yeah, so let's go to the next video. Okay, so as a previous course, you have learned all the basics. So now we're going much more deeper about the trend. Okay, so the previous video talked about Elliott wave. So Elliott wave, they will be forming with the five impulsive. Okay, this is five impulsive wave, then and ABC with a corrective wave. Okay, usually for the Elliott wave theory, they say the center wave here, which is number 3, 1, 2, 3, will be the longest wave. Okay, but not always, usually. So but in the risk scenario, sometimes it will be even be more than 5 wave. Okay, 1, 2, 3, 4, 5, 6, 7, 8, like that. Okay, so in the last trend, usually you will see when the trend moving over, you will see a spike here, then the price moving down, then ranging before the price going back downwards. Alright, so today we're going to much more deeper about this. Okay, so when you can see there's uptrend, so you will buy at the low, right? Okay, buy at the low here. Okay, alright, good. So this is very common sense. Everyone will like buy at the low. Okay, so we're going to talk about the story of the big boy. Okay, how the big boy building the positions. Okay, so usually they will have an accumulation here. They were ranging around here, the price before they moving upwards. Okay, what is the purpose of the price moving like this? Okay, so when the price moving like this before they moving upwards, because the big boy is building buy order here. Okay, so they want to make the market looks like a range, so they will involve a lot of seller coming in, so that they will make all the seller coming in, so that they can buy from the seller. Okay, they need seller in order to move the market up. Okay, in order to build their position. Okay, so let's say this big boy, sorry, okay, let's say this big boy, this guy, they are standing here right now. Okay, in their hand they got $20 million. $20 million, which is this fund they might get from all the investors. It's like maybe this is big boys who will represent bank, institute, hedge fund, market maker. So they got 20 million they want to buy now. So their aim is until they got the target. So their target maybe around here. Okay, maybe around here. Okay, they will want to move the price from here to here. They already set their target, but how can do that? Okay, how can they do that? Okay, so first of all, the big boy will you will see the price in the range, right? So when the price hit here, a lot of people selling, the big boy will keep buying here. So big boy coming in to buy in all the way. Okay, so they will buy in all the way. So when too much buying, the price will go up again. Okay, go up again, go up again. Then after that, people see here again, then they will push the price down because they want to sell it again, because maybe this here is the downtrend, so people will follow the trend, right? Trend follower and range trader and the retracement trader or pullback trader, or they were willing to sell over here. A lot of people willing to sell, but in this timing, our big boy, they will know the market going to turn around, so that's why they are buying over here. Once they fulfill, let's say they already fulfill $12 million here, $12 million here, but eventually there's no more seller for them to buy again, so the price will become expensive. Okay, it will be increased. Okay, the concept is like what you are buying a house, there's too many buyers, so in more than the seller, it won't be in order to achieve equilibrium, the price will be increased higher and higher because there's too much buyer already. Okay, so you need to reduce the buyer, so the price will be increased higher and higher. So same concept here, the seller is now this condition. Initially part is seller more than buyer. That's why big boy buy. Okay, so after that a while, can see keep ranging. Then the seller now started almost same like equal to buyer already. Okay, equal buyer, they are, so that's why ranging here, buyer and seller are fighting. Okay, so eventually when there's lesser seller, more buyer, so the price will be increase the price right now because no more discount, too much buyer, so the price will break out here. Once the breakout here, a lot of trader like breakout trader will join here. Okay, they will join there, then they're pushing the price up again, pushing the price up again. Then after that, the market feel that the price now is expensive because previous was just like this only, so low. Now here market will feel expensive, they give some discount. So our buyer now maybe put in another $2 million here. They will buy another 2 million. Then the price push back up again. Okay. Then after that, the market feel that expensive again. So they give some discount. The market gives some discount. Then the pullback buyers and big boy will put in 2 million again. Then they ride the trend, go up again. Okay, they go up again. Okay, so now plus another 2 million. So now how much? You got 20 million initially, right? So now they use up 16 million already. Use up 16 million, they are left 4 million in the hand. 4 million. So maybe here they put in maybe $1 million. Okay, now put in $1 million. So now they left only $1 million in the hand, the big boy. Okay, alright. So until here, the price moving up, right? Your big boys is getting great profit already here. So they think that okay, it's enough for me. As soon I will take profit. Okay, I'm going to take profit. So when I'm going to take profit, I still got 1 million in the hand. I just make a last push here, push the price up. I throw all in 1 million. When I throw in $1 million, okay, the price will be move up because initially here will be a little bit pullback, right? A little pullback. Then a lot of people will, some smaller time frame people will sell it over here. Then once you throw in $1 million, a lot of smaller time frame stop loss got stop out, then turn into buying pressure. So even though, and even they put in 1 million, even more buying pressure, you can shoot up the price higher up. Okay, here, and a lot of people jumping to the buy side here, buy. A lot of people now turning their mind, they want to buy, they losing to missing out any good trade. Okay, they want to buy, after that, the you can see there is sharp movement downwards. Okay, let okay, you think that why this sharp movement will be come down so sharpen? Okay, because they push up, then why the big boy willing to let the price go down like this? Because they want to take profit with the high price, right? Why the So this is the reason, because there's a 20 million on the hand, right? Now they are starting offload their $20 million. Let's say here they start offload $2 million here. Okay, they start offload $2 million, then you see market go down very fast. Okay, go down very fast. Then over here usually will be ranging because they want to offload more of their money. It will keep ranging here because people will see the sharp move here. People now tend to buy. Everyone want to buy. Okay, everyone want to buy. So now he start to sell out the $20 million stock in the hand. Okay, they're selling out everything. So the more buyer, the merrier. Okay, he will happy because he could purposely create this one artificial move up. People will tend to buy now because you see like the momentum getting stronger for all price action trader, all will come in because they say yes, momentum stronger right now. So but they got into this trap. Okay, they got into this trap. Then the price start ranging here. So when the seller offload, and after they offload, they adding the sell position now. Okay, they take their profit and turn into the seller right now. Okay, so after that, the market soon the same thing again. Soon they enough fulfill their order. Now they become seller now again. So this process will repeat over and over 100% of the time. Okay, so let's say previously class you have learned about the market stage, right? So the stage is ranging. Before ranging, they have the play, right? Before they move up, then ranging again, the play, then move down, then you over again. Okay, so this is the same concept here also. We just combine all the Elliott wave theory and this chart pattern, everything. This is all proven and is published by a lot of books, but I just combine all the theory together so that you can understand more about this. Okay, initially the building position with ranging, then they will come out with this one, the ranging, right? Come out the play. Okay, the play, they play out all the buyer and seller here. Okay, because they want to be only buyer now. Okay, they want to grab all the stock in the market. That's why even though you are buying here, they hit your stop loss here, then they move away, because once you hit the stop loss, your buyer stop out, they will absorb all the stock, then all will be in their hand. Okay, so even though you are buyer and seller here, usually you are losing money still. That's why 96% of people losing money because of the evil of the big boy. Alright, hope you can have an aha moment by now. Alright, thank you very much. Okay, before start, let's go back to the basic again. So what is uptrend and what is downtrend? Okay, so when there's uptrend, we need a higher high, higher low. So this is higher low, this is higher high, then need another higher high, then another higher low, then higher high. Okay, so when there's now downtrend, lower low, lower high, lower low, lower high, and lower low. Okay, so this is uptrend, this is downtrend, then ranging is like this, ranging. Okay, the price go bounce here and there. Okay, then channel or ranging also can be another angulated one. Okay, angulated one. Okay, like this. Okay, or like that. The price come in, hit. Okay, so this is the basic. Okay, now come to the counting legs parts. So you now know the uptrend and downtrend already. So we need to count the legs. What is legs? Legs basically, if you uptrend this one, right? This one consider one leg, this one two legs. Okay, so now we get more into detail what is legs. So when market move up one legs, then it pull back, another legs, pull back, then another leg. Usually, commonly, will have 3 leg in a trend. Okay, sorry, 2, 3 leg in the trend, but sometimes it will be more. Okay, so for the pullback part, at least will be two leg, 1 and 2. Then before it continue to another trend, uptrend again. Okay, so usually important part, at least two pullback. Okay, so when you're going to trade the pullback, so you need to wait for at least how many legs? 2 legs. Okay, when you saw there's a you apply your HMM, then you see there's a weakness, then there's a pullback here, but we don't buy it here first. Okay, this is only first leg. Okay, first leg. So usually it will pull back, then to form another leg. So 2 leg only we will start thinking we want to go in or not. Okay, so 2 legs, but sometimes it will be 3 legs. So later on in the following chapter, I will tell you when is the most suitable time to go into the market. Okay, Hi, today lecture we're going to discuss about the price movement. Okay, so as we know that the price movement, the price either will move up, down, or sideways, right? Okay, so when the price move up, we call uptrend. When the price move down, we call it downtrend. Okay, when the price moving sideways, we call it as a range, right? Okay, so this is very basic. So I today going to talk about the back to the basic, but because it's important, that's why I need to emphasize. The first one is that we're going to talk about the trend. How you're going to identify there is a valid trend. Two, talking about the channel. Channel. Three is a range. Okay, range. Okay, so these three I think you already know, but today going to highlight and emphasize it. Okay, trend. So how you going to define this is the trend, or what is that price movement? Okay, for the trend to be a valid, go up, the higher high, higher low must be have a higher high, higher low, another higher high, higher low, and higher high, right? Then for the trend to be valid, this high need to act as the ceiling here, right? Need to act as the floor of this one. Okay, so when the price need come back, need to respect this level, then go up. And when come down again, need to respect this level, then go up again. Okay, so the same rule apply to downtrend. Okay, so from downtrend, the price moving down like this, right? So need to respect this support and resistance level. Okay, for the channel to be worked, so the channel must be moving. This is moving like that. Okay, moving like this. Then you can see this one, the high here, it won't support the price. Okay, it will go down all the way, then come back up again. So from here, right, you can see it won't act as a support and resistance. So for channel, it won't respect the support and resistance. So when down channel, also the same. Okay, also the same. So it won't respect the like a trend support and resistance level. So a range, usually we call it sideways. You're moving like this. Okay, so you have a equal high and equal low. Okay, so now we're going to talk about these three. So how you know that the price is going to reverse? So the price will be seldom and rarely moving up, come back down like this. It will happen, but it won't happen so fast. Okay, so it won't come up so fast and down. Okay, so usually you will have some sign before it turn around. So if you see the sharp move, usually you go to the smaller time frame, you can spot the turn also. Usually you will have a trend first. So from a trend, you will slowly become a slowing down, become a channel. So from a channel become a range. From a range now become a channel again, then become a downtrend again, like this. So you from here you can see support and resistance is respect it, then that become a channel, from a become a range, channel again, then become a support and resistance again. Okay, so the next video we're going to go into the real example. Okay, in this video we're going to this example talk about the trend, channel, and range. Okay, so from this 4 hours chart, pounds New Zealand, so you can see the price moving upward is an uptrend. How you know? You can see the price, it never break the support and the support or resistance for downtrend. So you will respect, you can see the pin bar, you respect this support and resistance level. So from here we draw a line, you respect it again. Okay, so let's see. So now price moving up again. So this is the previous high, right? So will it respect? If not respect it, so it might turn into the channel. So the price coming up, coming down, then moving up very fast. So this one is like a hunting like that. So it still respect the level. So the price now go again. Okay, now you can see the price challenging this level, but after that it go back up again. So it's like nothing happened over here. It still respect this level. So, okay, so now this is the high here. Let's see where it respect. Then this is a high here. Can see starting break the level. Okay, this is a very big candle. Something starting challenge it. Okay, something started challenge it. So this is the high. Now the price come back down. Okay, so from here you can see, from here the price moving very fast, then slowing down. Okay, so from here, right, start from here, you can see the price moving up, come back down, moving up again, come back down here. So from here, right, the price moving back up. Okay, so you can see that the pullback here is deeper, getting deeper compared to the initial pullback, shallow a little bit. Okay, it's getting deeper and deeper now. Okay, so from here you can see very deep over here. Okay, so something is wrong. So from here you can see the price slowly can see like something like a channel now. Okay, like a channel now. So from here you can see the price moving a little bit sideways right now. Then you can see the price moving up, down. Is this a hunting? So a lot of buyer trapped over here. Okay, a lot of people buy here because when everything become obvious, you don't follow. Okay, so when you see here buyers getting more and more and more, and the last here you can see very strong up push with a big candle. From here everyone the eyes were looking at it, everyone the eyes were looking, whoa, there is a buy, must be a buy. You can see the candle so big, this three candle. So what I learned in the school taught me that big candle meaning strong momentum must be a buy. So when the people jump in over here, a lot of people going to get stuck around this level. Okay, you can see, and after that very strong seller coming in with a high volume as well. Can see they have a almost equal high volume here. So the price push back down to the previous high again, so back to the range again. Okay, so let's see. So the next seems like going back down already. Okay, the price coming down. Okay, coming down. Okay, so you can see this is a small range. Then I think it doesn't form a lot of range because the seller is too strong, because a lot of buyer here, they trap a lot of buyer, a lot of people they put their stop loss here and there. So once the price moving down, a lot of buyers, they will hit their stop loss or they're quick. Okay, when there's a lot of buyer quick, the price going to move down very fast. Okay, price moving down. Okay, yeah, hope you learned something today. Okay, for this course I would like to describe the candlestick pattern everything into like a war, okay, like a war. So if a war, what we need army, right? So this chapter now we're going to discuss what is army camp, okay? Army camp, we need to identify the army camp first before we can fight, okay, fight for the opponent. So our army, so we would need to identify, we will have the seller and buyer, right? So we got the seller and buyer, so that we can decide what camp on that specific region, okay? So right now we're going to have to look how to identify army camp. Okay, so from here you can there see this uptrend here. So the where is the army camp? We want to identify the army camp is anything like over the pullback here. This is army camp, okay? Then it going up, the pullback. Then this one haven't go up yet. One is go up here. This is army camp, okay? Go up. Then this one come down, go up. This is army camp, okay? So army camp is important to identify. So now this is buyers, okay, buyers army camp, okay, buyers army camp. Then we look for seller army camp. Once you see the price going down, okay, breakthrough here, okay, this is army camp, okay, it go up, then it forming the small M. You can see this is small M. This is army camp, okay. Then this is the shape is like a V, another V, right? Like that. Also army camp. So previously we have learned what is M, right? M, you got a few kind of shape. Sometimes it will be V, sometimes it will be M, sometimes it will be much more kind of shape, right? Sometimes it will be lower a bit, sometimes it will be higher a bit, sometimes it will be 3, like that. Sorry, like that. So doesn't matter, as long as you can see something like that, there's army camp, okay. So now you look for army camp. So here also can see there's army camp here. So the next video I explain to you why this is so important to look for army camp, okay. This army camp. So army camp inside a lot of guns, bombs, everything, right? So it's dangerous. So we need to identify the dangerous area, okay, dangerous area. Okay, then this is army camp, okay. Okay, now the second video, now we're going to further explain about the army camp. So everything when you see there's a upward movement or downward movement that break through a certain point is like that, breakthrough here, this is army camp, okay. This guy started, okay, started go up, okay. Find the started area, the initial part. So this is army camp, that initial part, okay, initial part. So why this is important? Because the army camp there's a lot of army, so it's very powerful. This is their area, okay, this line is their area. So once you touch it, they'll fight you back. You touch it, they'll fight you back, okay. That's why it's important. They will hold it until they cannot hold, then they'll drop, okay. This army camp, this power of army camp. So you need to look for any army camps there. There's all is army camp, okay. So find one more simple one, easy to explain to you, okay. So you can look for it in other time frame also. So all the time frame can use this concept, okay. Okay, so this one is the army camp, okay. This one started, then they come out from the army camp, okay. This one, then they come out from army camp. So this line important, this one important. So we don't say as a line, but rather than a zone, okay, a zone. So you draw from the gate here to the back door here, okay, a zone, okay. So this guy leaving, then this is army camp, okay, this is army camp.